With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, April 5th, 2024. Some shout outs to Bub, to Mike and Carol, Angelique, Frank, George, John, all the folks that are tuning in week in, week out. We really greatly appreciate it. Glad that you're getting some value out of this. So let's go ahead and jump into the numbers. It was a bit of a roller coaster ride for the market this week, one that did end on a down note. So Dow Jones Industrial Average was down 2.2% this week. The S&P 500 down 0.95. The NASDAQ Composite down 0.79. The Russell Small Cap Index down 2.8% this week. And we take a look at the volatility index. It shot up big time this week, up 23%, up to a level of 16. That's still rather tame for the VIX. The VIX can go a heck of a lot higher. Whenever the VIX goes over 30, you just buy everything you can. I think we're really far away from that happening, but we could see a 20-something. You never know. But it did spike up a bit this week. Take a look at long-term bonds as measured by the TLT, down 3.4% this week. So we had pain in both stocks and bonds. Nobody was spared this week. Well, there were areas that were spared. We'll talk about those in a moment. But as far as the general asset allocation titles that we like to look at, they were all pretty much down for the week. As you take a look at the sectors, you can imagine a lot of negativity. Retail sales were down 5% and semiconductors down 1%. Even utilities, more defensive, they were down 0.7%. And other things were down 2 to 3%. But we did see some positive areas. The energy was up 3.8% this week. Really happy that we have some overweight there to energy stocks with Chevron and Devon and whatnot. They really performed very well this week as oil continued to climb higher. And looking at industrials, they were only down 0.2. Materials, they were flat on the week. Gold and copper continually do, really, really strong. Gold was up 4.5% this week. Silver was up 10% this week. Communication services, things like Google and Facebook, they were up as well, up 1% on the week. So although it was a rough week for the indices, there were definitely areas of the market that showed some strength. And really the biggest amount of pain came yesterday on Thursday, April 4th. I was actually talking to a group on Thursday and mentioned that one of the Fed chairman, Neil Kashkari, he's known to be a really big dove on the Federal Reserve Board. So look, the Federal Reserve members are classified as hawks and doves. A hawk is someone that's uber concerned about inflation and willing to keep rates higher for longer or even raise rates to break inflation. And a dove is someone that doesn't care so much about that. They're much more interested in putting gas in the engine here and pumping more money into the economy by keeping rates low or lowering interest rates and just pumping money into the economy. So hawks and doves. And Neil Kashkari has always been a dove. Just crazy about it. Always just wanting to dump money into the economy. And then on Thursday, he said that he didn't think that the Fed needed to potentially cut rates at all this year. And we saw the market down a lot. But you know what? I was mistaken on that being the reason. The reason why the market really took that beating on Thursday was a story that came out geopolitically regarding Iran and Israel. Iran had made a threat of potentially striking Israel within a 48-hour time period. And that's actually what started the market going down. Then Neil Kashkari spoke up and actually accelerated the move downward from there. So a couple of things about all this. First of all, when it comes to the geopolitical risks, things like wars and skirmishes and things of this nature, they tend to be knee-jerk reactions for the market. The market tends to react, sometimes pretty ugly, and then it turns, it settles and turns. I think we talked about this back when the Russia-Ukraine war started, that the worst of the market usually happens before the war actually breaks out. And then once the war starts, you usually see markets go higher. And I would expect that to be the case no matter what tends to happen out there in regards to geopolitics. On the other topic regarding interest rates, I have to say that I'm really just impressed with the resiliency of this market. Coming into this year, I thought the biggest risk to the market was that it was not going to get what it wanted. The market was pricing in 6 Fed rate cuts beginning in the month of March. And we put in our newsletter, we said, forget about it. Just not going to happen. We didn't expect that to happen at all. We said we'd be lucky if we get 2 or 3, probably not even to the last half of the year. Well, we thought that as the market woke up to that idea, it would probably have some pain and probably dish some pain out. It really hasn't been the case. It's really hung in quite well. And not only did the market expectations move from 6 rate cuts to about 3, now we're hearing Fed board members coming out saying, oh, we really might not cut at all. And the market seems to be taking that in stride. I think that's a good thing. I mean, look, the fact that they don't think they need a cut is an indication that the economy is showing resiliency. And we're seeing that. We saw ISM manufacturing numbers turn positive for like the first time in 2 years. Not that we're seeing some sort of wild acceleration in the economy, but we are seeing some improvement in some of the areas that have been lagging and not doing so well. So those are good things. But I did expect the market to have a bit more of a temper tantrum over not getting its way. I don't think the Fed should cut rates with the economy as strong as it is. And look, we had another jobs report today, 300,000 jobs, much more than expected. Economists looking for 200,000. The unemployment number ticked back down a 10th. And maybe the biggest part of the story is that the wage increases were not out of control. And they were up about, right in line with expectations, around 0.3 or so of a percent. So what you really have to worry about when it comes to inflation are wages really pressing higher, much higher than the market is expecting. And they weren't. They were actually in line. So a lot of jobs created, wage growth seeming to stay tame, and unemployment ticking down. So things are looking pretty good with all of that. It gives the market reason, I guess, to hang in there. Now, we've got earnings are going to start in earnest this coming week. Bank earnings are going to start next week, and that's what we'll be talking about for a few weeks. I think that when you take a look at some of these early reporters that we've seen in the last few weeks, they're actually reporting pretty good results, and things are looking a little bit more positive. Again, I don't expect some sort of explosion in earnings growth, but I do think that we can see more improvement in earnings as we move forward, and that can kind of bolster the market as well. But, when you saw what happened on Thursday, you have to understand this, folks. The market, let me tell you something. If it can get the excuse that it needs, it will cash in. You will see a drawdown. You will see a correction. I want to give you a little bit of data. When the S&P 500 has historically had a first quarter as good as the one we just had, up just about 10% on the quarter. When it's done it in the past, it's been like 15 occasions. 13 out of 15 times we had 2 big corrections during the rest of the year. The average of the first correction was 11%. The average of the second was 12.5%. Those are pretty big moves to the downside. In 14 out of 15 instances, the market still finished higher for the year. But we saw a lot more volatility for the remaining 3/4 of the year, okay? So we just had a great first quarter, and if history is any indicator of what could lie ahead, I would think that we could see more volatility. So I like where we are right now as far as positioning. We've got some cash on hand. I did not deploy any of that this week. Boy, I was watching a few things on Thursday, let me tell you. Was salivating a little bit, but not ready to pull the trigger yet. I really like to see the S&P down 5%. If we can get down 5 on the S&P, that cash gets put to work unless some great opportunity pops up ahead of time. And then if we get down closer to 10, then I'm actually going to be selling some bonds and buying some more stock. I don't think recession's imminent. I think it's coming probably, but more like end of 25, maybe into 26. I think the market has lots of room to go higher. I think there's a lot of gas in the tank. I'm actually targeting around 6,000 on the S&P, maybe a little bit more than that, 6,100 and change based off some of the technical folks I've been talking to. So we want to position ourselves for that. If the market gives us that opportunity, we're going to buy it, and we're going to do that. And if it gives us a great opportunity, we'll buy more. We'll give her some bonds, even buy some more. And then we'll worry about adding more to bonds later. So that's where things are. Things are going to start heating up a little bit next week with earnings. We'll be ready for it. The market gives us some opportunities. We've got cash on hand to do some buying, and it looks like it's getting ready to happen. I know it sounds crazy that your financial advisor is wishing ill will on your portfolio, wanting the market to go down. But believe me, folks, that's when we make the most money. And I want this bad boy to drop. I want it to fall. I want the people to be scared and running for the hills so we can come in and take advantage of it and buy some stuff and make some money. All right. So between now and next week, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe it's sell your business and retire. Maybe it is travel across the country on a motorcycle. Yes, I'm talking to a client this week. He's leaving the Dakotas on a motorcycle going to Greenville in the Carolinas. I mean, boom, that's a crazy trip. But go for it, buddy. You're a stronger rider than I am. I have a bike, but I do not ride it like that. So that's awesome. Maybe it is helping a kid with college or paying for that wedding, which I was talking about with a client this week. You know what your goals are. Don't just think about them. Think big. Think big. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.